Welcome back. The price of gold continues to test record highs this morning. It comes amid a 10% rally in bullion so far this year. There's a look at the June contract on gold, 2,298. We were at 2,304 or so earlier in the morning. These are new highs. The intraday high today I'm seeing is 2,308, almost 2,309 US dollars per ounce on bullion. So the rally remains intact, at least for another day. Let's bring in an expert to talk about this. He is Daniel Ghali, Senior Commodity Strategist at TD Securities. Daniel, thanks a lot for coming in.
Yeah, thanks for having me, Paul.
I've read a bit of your note. You say the balance of risk on gold has begun to tilt to the downside. It sounds like you see this rally at least pausing, correct?
Yeah, that's right. I mean, if you think about it, as you rise in altitude, the air gets thinner, right? As gold prices continue to print new highs day after day, it actually seems to us that buying activity is declining from most of the major cohorts that you typically expect to buy gold. Right. The latest central bank demand data just came out this morning. It's down 40% year on year, 60% month on month. We also know that the dislocation in positioning that allowed gold to rally so far has really come from macro traders. At the start of the year, they were historically underpositioned for a Fed cutting cycle, and that dislocation has largely resolved so far. You also have a very strong physical demand activity, but we're seeing signs of buying exhaustion out of China, and again, as we mentioned earlier, from central banks.
Buying exhaustion. Now, what does that mean?
Well, Chinese retail investors have really been piling into gold as a safe haven, given the decline in real estate prices and their local equity markets. We now see signs that that buying is grinding to a halt.
How much of a presence are central banks in the picture? Over the years and decades, there has been sometimes concern that central banks were reducing their holdings of gold, putting gold onto the market. That would be a negative for pricing. More recently, the narrative, I believe, is that central banks have been buying gold. You're now saying that they're slowing down their paces of purchases. How big a footprint do central banks have in this market?
Well, recently, they've had a very large footprint, right? There continues to be year after year since the pandemic, record highs in central bank demand. Overall, last year, they bought about 40% of global gold supply, right? So they are very significant, but that doesn't mean that they're out there buying gold every single day. And in fact, we now think gold prices may have overshot to the upside.
What about the view that the equity market is taking on interest rates? We've seen equity markets cool off in these early days of April. One strategist spoke to us earlier this morning, says his take was it's about time stock market investors realize that central banks may wait longer than hoped to begin reducing rates. How should gold be reacting in that type of environment?
Well, that's what's interesting, right? You've had rates market expectations cool off. People thought at the beginning of the year, they thought 6 interest rate cuts for 2024, and now it's actually less than 3, less than the Fed has actually communicated in the dot plot. You would expect macro traders to take off some gold length or even to add some shorts in gold. But because of that dislocation that we mentioned earlier, at the start of the year, they were already historically underinvested in gold. That gave you a period of time where Fed cuts could be removed from market pricing and gold could rally. That's no longer the case today. And as Fed cuts continue to be removed, gold macro traders should sell gold in response.
So you're cautious on the gold market. Do you have an estimate of where gold's going to trade 6 months or a year from now?
Around 2,200 on the 6-month horizon, right? So we're not looking for very significant selling activity unless the macro outlook changes. But as things stand today, 2,200.
Crude oil, can the rally in crude oil last? We're at nearly 86 US dollars per barrel today.
Well, here's what's funny, right? We started the year with these dramatic dislocations in market pricing. The macroeconomic outlook actually hasn't changed all that much, but there's been wild swings in market pricing across global assets. How that relates to crude oil is really around Chinese demand sentiment. Chinese demand sentiment was probably oversold to start the year and now appears overbought to us. The Chinese economy hasn't improved all that much. The macro data isn't strengthening all that much, but the reaction in crude oil prices has been very significant. There's a lot of talk about supply risks in crude, but in our view, supply risk premia is actually being taken away from crude oil markets. This is a demand-driven rally, which explains why every commodity out there is rallying at the same time.
Including copper. Why don't we finish with copper? It's It's an important one to the Canadian stock market as well. We have some high-profile miners here that mine copper. Copper has vaulted up to, I believe, the $4.10 level. There you see it, 4.17, in fact. So the copper rally remains in place. News out of China has driven the copper market over the past month or 6 weeks.
Yeah, that's right. A lot of attention has been paid to reports that Chinese smelters are going to curtail their production in response to lower processing fees. They're not generating enough margins to sustain the massive amount of capacity that they've built up over the years. That's what catalyzed the rally. In reality, that has very little impact on physical copper markets. Physical copper markets are trading extremely weak relative to the benchmark prices. This seems to be a speculative-driven rally, and in our view, it relates to money coming off the sidelines and into broad commodity indices.